Current U.S. President Joe Biden and former U.S. President Donald Trump may hold opposing views on various issues, but they appear to share the same point of view on China. They are either with us or against us. Biden is pressuring U.S. allies to choose sides in an escalating global technology conflict. The United States' recent ban on the sale of semiconductors and chip-making equipment to China represents a fundamental shift in the Biden administration's attitude to its main geopolitical nemesis. That challenges Beijing and poses difficult issues to allies, putting Washington in a bind on how far it is ready to go to get them to cooperate. It's a complex situation, but what does it mean to the U.S. economy and the rest of the world? So far, it is reasonable to claim that several U.S. sanctions placed on China have aided the mainland semiconductor industry. It fueled demand for domestic components, with China-based providers of design software, processors, and chip-making equipment outpacing global heavyweights, Taiwan Semiconductor Manufacturing Company, and ASML holding NV in sales growth. But there is little doubt that the Chinese chip industry's path to self-sufficiency was paved with several restrictions and suspicions. After all, China's military and economic aspirations are both envied and feared by many, particularly the United States. So, to defend their interests, the U.S. has consistently obstructed Beijing's access to crucial technology. What began as a Trump administration crackdown on telecom giant Huawei has grown into something far greater. Today, the Biden administration is focusing on China's aspirational self-sufficiency goal, and it no longer includes just a few enterprises. According to President Biden's most recent national security policy, the world's major countries are vying to shape what comes next. According to the media, it's a tech war. The use of the word war emphasizes how governments regard technology research and development as a crucial national security concern. In an era where the United States has been losing momentum by some metrics, the Biden administration is now adopting an assertive approach, spending tens of billions of dollars on domestic high-tech businesses while seeking to prevent China's technical progress. However, war is a worrisome perspective through which to view the U.S.-China rivalry. It runs the risk of militarizing economic, scientific, and technical competitiveness, reinforcing justifications for expanded military budgets and brinksmanship. War rhetoric has the potential to promote nationalism, prejudice, and oppression. However, there are reasons for the sense of urgency that a hypothetical war can produce, given the transformational nature of some coming technologies, such as AI or biotechnology, as well as the conflicting trajectories of the US and China. By many measures, the United States looks to be losing ground in R&D. In the years following World War II, the US government funded around 65% of all research and development in the country. Now, that ratio is 24%. Not only has the US government spending on R&D decreased, but other nations have risen to the top of the list of R&D funders. In 1960, the United States accounted for 70% of worldwide research and development. By 2018, the United States had a 26% share, while China had a 21% share. Meanwhile, China is coming forward with the Made in China 2025 initiative in an attempt to make the nation dominate many technology industries, including AI, semiconductors, and biotechnology. China has already gained the lead in several sectors, such as communications infrastructure, becoming a powerhouse in the world of telecom equipment that serves as the underpinning for the next generation of smartphones. In recent months, the Biden administration appears to have become more active in its efforts to maintain the U.S. edge in research and development. The administration unveiled what analysts describe as crippling rules intended to suffocate China's semiconductor industry, the industry that produces computer chips that could enable the most recent advancements in artificial intelligence, or AI, and supercomputing, a few days before declaring the end of the post-Cold War era earlier this month. The administration issued laws prohibiting the shipment of advanced chips to China, the equipment required to create them, and even foreign-made chips that incorporated U.S. technology throughout the manufacturing process, claiming that semiconductor research may benefit the Chinese military. A recently passed bill will invest $52 billion in domestic manufacturing and semiconductor research and development, making it one of the federal government's greatest industrial development initiatives. The policy has also sparked the attention of the private sector in semiconductors. Other such signals are being sent by the Biden administration through an endeavor to invest in biotechnology, including a $2 billion investment in bioeconomy research, development, and infrastructure. Chinese semiconductor companies have historically relied on foreign expertise to keep up with Western competitors like Intel and Qualcomm. Richard Chang, a Taiwanese American, founded the Shanghai-based Semiconductor Manufacturing International Corporation, or SMIC, China's largest contract chip producer. Meanwhile, around one-third of SMIC's engineers were foreigners, including many Americans. Prior to the current restrictions, U.S. authorities concentrated mostly on preventing chip designers and manufacturers from selling their goods to the Chinese military. A complete prohibition on the sale of equipment and tools that are required to manufacture advanced chips, particularly those required for artificial intelligence applications, has now been implemented. Washington is counting on its influence in the global semiconductor supply chain to prevent China from getting the capacity to manufacture semiconductors at 14 nanometers or higher nodes. A nanometer is the size of a transistor, which is the building block of a chip. The smaller the size, the more transistors that can be stacked onto a chip, making it more efficient and cost-effective. The limitations also prevent U.S. citizens, residents, and green card holders from working in China's semiconductor industry, requiring the Chinese government to reinvent the wheel in this critical technological field. Concerns are emerging in business boardrooms and defense ministries that mutually assured economic annihilation may not be enough to keep the Taiwan Strait peaceful. Multinational corporations have invested billions of dollars in Taiwan and China, assuming conflict is simply too expensive. However, Germany's gamble on the same concept for guaranteeing its energy supply has gone catastrophically wrong this year. The cost of conflict may appear to sway Xi Jinping more than Vladimir Putin. However, as seen by its economically catastrophic COVID lockdowns, China's policymakers are no longer so focused on economic progress. Even executives who believe the likelihood of conflict is remote cannot overlook more urgent policy changes brought forth by the U.S.-China chip conflict. The U.S. tightens its chip choke, imposing fresh limitations on China's access to chip-making software and equipment. Some international semiconductor companies with Chinese operations are paying the price for failing to foresee the new regulations. Sky Hynix, one of South Korea's two leading memory chip manufacturers, is currently prohibited from upgrading essential lithography equipment in its Wuxi, China plant, preventing it from creating next-generation chips there. Non-Chinese enterprises are adjusting their investment patterns as a result of this. Subsidies are also affecting the structure of the industry. The recent passage of U.S. legislation to incentivize semiconductor production has prompted TSMC and South Korea's Samsung to develop new facilities in Arizona and Texas, respectively. Europe, Japan, and India are also implementing their own semiconductor subsidies. The manufacturing of chip-making materials and supplies will move as the site of semiconductor fabrication shifts. China, on the other hand, has the largest semiconductor subsidy program, with the national government, as well as provincial and municipal governments, continuing to pump money into the chip business. A slew of new factories making low-end processor chips is ready to go live, lowering prices and sparking dumping allegations and trade fights. More immediately, government subsidies to Yangtze Memory Technologies Corporation, a manufacturer of NAND memory chips in China, appear to be reaping the reward. Apple is exploring using YMTC processors in upcoming iPhones. Previously, this sort of chip was obtained from South Korea, Japanese, or American firms. Subsidies from China and America's chip monopoly are driving change downstream as well. Apple is expanding iPhone production in Vietnam and India, where its tightly regulated supply chains affect how the whole industry acquires components. The most telling clue is that Apple may employ different components for phones aimed at Chinese users more than those marketed elsewhere. Meanwhile, Apple has informed U.S. lawmakers that it will exclusively utilize YMTC memory chips in phones sold in China. Similarly, after the U.S. tightened restrictions on chip exports to China, shares in Asian semiconductor producers and suppliers have lost attractiveness among investors even further. The Bursa Malaysia Technology Index, or KL-Tech, has dropped as much as 5.96% after the news. KL-Tech is down 21.64% in the previous 6 months. It was 57.24 points on Wednesday, October 19th, down from 72.10 on April 19th. Felix Li, an equity analyst for semiconductors, added that the recovery of the semiconductor business as a whole is also dependent on the Chinese economy, which is the world's largest buyer of chips.